Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This is where you get everything you need to know in 90 seconds at 9 o'clock. With news, China's banking system has scored another dubious benchmark. But first, Janet Yellen spoke over the weekend, and her message was clear. The Fed will raise rates next week, barring any unforeseen situation. It was a surprisingly clear signal from her. Usually such guidance is couched with all sorts of vague caveats. She directly said that the process of scaling back accommodation likely will not be as slow as it was in 2015 and 2016. The end of easy money is near, at least from the US. Analysts now see 3 rate rises in 2017, taking the current US benchmark of 0.75% up to 1.5% by the end of the year. In China, the news workers there are pumping out the official stories from the Chinese Communist Party's big meeting over the weekend, setting goals for the next 5 years. But through all the spin, what has been revealed is that growth targets are being lowered to 6.5% for 2017, policies are being relaxed to welcome foreign investment, and new policies to raise domestic demand are on their way. And it should be noted, President Xi gets relatively low marks for meeting his stated goals over the past 5 years. And the FT is reporting that China's banking system has grown past that of the Eurozone to become the world's largest by assets. But it is a sign both of the country's increased influence in world finance and reliance on debt to drive growth. Chinese bank assets hit $33 trillion at the end of 2016, compared with $31 trillion for the Eurozone and $16 trillion for the US and just $7 trillion for Japan. The value of China's banking system is more than 3 times the size of the country's GDP, compared with 2.8 for the Eurozone and less than 1 time for the US. In New Zealand, the ratio is 2 times. This massive size in China is a sign of an economy overly dependent on bank-financed investment, beset by inefficient resource allocation and subject to enormous credit risks. However, the direction the Chinese are taking their economy will be good news, that's in quotes, for Australia, even New Zealand. That's good news in the short term at least. The focus on holding up relatively high growth levels, even with all that debt, will keep demand for iron ore and dairy products high for the plannable future. And commodity prices are enjoying their best run-up since 2013, fresh evidence that investors are betting on a pickup in the global economy after years of sluggish growth and scant inflation. Oil and natural gas prices are rising again, even if fitfully. Precious metals like silver and materials like lumber have scored big gains in recent weeks. But this rise in prices has attracted new producers, flooding markets from everything from oil and gas to aluminium and wheat. In New York, the US Treasury 10-year yield is now at 2.49%. Oil prices are pretty much unchanged to start the week, just over $53 for the US benchmark, while the Brent benchmark is just under $56 a barrel. The gold price is also lower, however, down another $7 to $1,225 an ounce. And New Zealand dollar has stayed at its lower level over the weekend. It is now at 70.5 US cents. On the cross rates, we're down to 92.8 Aussie cents, and against the euro, 66.3 euro cents. The TWI is down to 76.1. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.